Welcome back in. Yeah, I'm sure you're well aware the home prices have really spiked the last few years, and you may be tempted to sell now, but there are some things you need to consider before you do. Marshall Clay with the Welsh Group joins us with a wealth of information this morning. Good to see you this morning.
Hey, good to see you.
Let's start with selling. Some people, maybe they bought their home at $250,000, now it's worth double that, maybe even triple. They're tempted to sell. Got to be careful with the capital gains tax, right?
That's right. Okay. There's a lot of reason why people may want to move, whether it's downsizing or maybe they're changing locations or whatever. But I think if you're looking to move, particularly like you said, over the last several years, there's been a dramatic increase, probably 20 to 30% increase in home prices. So if you're looking to sell, there's a couple of numbers that you need to be aware of. Okay. So if you are a single filer, which means you're not married filing jointly, you're filing singly, you can actually exclude up to $250,000 of gain. So if you bought a house for $250,000 in your example and sold it for $500,000, you can actually be exempted for those first $250,000. Now, if you're a couple married filing jointly, that actually doubles up to $500,000. So in your example, again, if it was $250,000 and it becomes $750,000, you're excluded for all $500,000.
And by the way, attorneys will tell you, the state attorneys will tell you, that's why you should not leave your house in the names of your children, pass that on, because if they sell it, they're going to have to pay capital gains on that. All right, let's talk about exclusion rules, and this may affect people who say, well, I may want a second place to live. But there are some rules on that where you can get by. To explain those. Right.
So there's a lot of folks that have these second homes, and I think the rule is here that you had to have owned your home and lived in it for 2 out of the last 5 years in order to claim these exemptions. And so the key here is that this does not have to be consecutive. So if you lived in a house for 1 year as your primary residence, moved to that second home, lived there for 2 years, and then came back to this first residence and lived there for another year, that qualifies for this 2 out of 5 exclusion rule. And so this is allowable once every 2 years. So you can't do this, year after year after year. So you can only use it once every 2 years. And so when we're looking at this this gain calculation, if you're saying, well, how do I figure out whether or not I have a gain? Well, you take the sales price minus the basis, and that equals your capital gain. So if you sold your house for $750,000 and you had a cost basis of $250,000, then your gain would be $500,000 in that example. And so that's why it's really important to keep those records and make sure that you're keeping records of any improvements that you make.
You don't want that math to get wrong when the IRS comes a calling. All right, now let's talk about home improvements, because I didn't know this. There are certain things you can get improved on your home that are tax deductible. You can write off, such as?
That's right. So if you do anything that adds material value to your home, so routine maintenance would not count as an addition to that basis calculation. But if you add on a room, or if you make a material change to windows or something that adds
get a new deck or anything like that?
Get a new deck that materially adds value to your home, you can use that as an addition to your cost basis. Now, use your best judgment, right? Because some of these things aren't as black and white. They're not as easy as you would think. So you just need to be able to justify it if the IRS
and have the documentation. Obviously.
Absolutely.
All right, let me ask you about some ways to use equity, because a lot of people ask that question.
Yeah, so this is important if you're elderly, if you're end of life situation, you have a huge cost basis or a huge capital gain or unrealized capital gain in your house. You want to be aware that you don't want to sell that property if you can get away with it, because you receive a step up in cost basis, or your heirs receive a step up in cost basis upon their deaths. That means that the cost basis becomes the current value. So you can avoid paying a tremendous amount of capital gains if you wait. So if you need cash flow, you can tap into maybe like a home equity line of credit so that you can actually benefit from that equity and not have to sell that particular home in that situation, because you want to receive that step up in cost basis.
I told you there's going to be a wealth of information. We hope that helps a lot of folks, but we appreciate Marshall Clay from the Welsh Group. Appreciate it. Thanks so much, sir.